On June the 23rd, 2025, Vanguard UK announced that they are lowering their fees. I can confirm they saw the recent video and then decided to cut their fees. Joking, of course.
You're not that guy, pal. Trust me, you're not that guy.
But they have lowered their fees on 7 bond ETFs. Now, wait, before you click away because bonds are much more boring than stocks, this will still be an important and helpful video for your investment portfolio. Why? Because in this video, we're going to be talking about arguably the most important decision you will make when selecting your investments. That is your asset allocation. But before we go on to that, let me just quickly run you through what this Vanguard fee cut was in full. As you can see on screen, 7 Vanguard bond ETFs were cut, and they were all cut by 0.02%. Now listen, it's probably not one to tell the grandchildren about. These bond ETFs were already low fee, but now they're even lower fee, which is good for us as investors. Vanguard estimate this fee cut will save investors $3.5 million annually in fees. There's a range of bond funds on this list, from UK bonds to emerging market bonds to corporate bonds. However, the one that catches my eye the most is the top one, the Global Bond Fund. I actually mentioned this in Stop Waiting Start Investing. I personally believe the easiest and best way to invest is through a global stock fund. Funds such as the FTSE Global All Cap or the FTSE All World are good examples. Why? Because you just need one stock or equity fund. And I apply the exact same approach to bonds. If you did want bonds in your portfolio, then the easiest way to go about it, in my opinion, is once again just to add one global bond fund, such as this one on screen. It's a passive bond fund and it's a global bond fund, giving you instant global diversification across bonds. But not just global diversification, it's also diversified by bond credit quality, by bond credit maturity, and by type of bond. So the beauty of it is you can add one global bond ETF or index fund to your portfolio, and that's all you really need for that instant global diversification. So using this global bond fund as an example, how much money will you actually save with this fee cut? The average historical return of bonds is about 5% per year over the long term. So on the current fee of 0.1%, your net return would be 4.9%. If we were to assume you're going to invest £500 per year for 30 years, well, after that 30 years at 4.9% per year, you'd have just over £400,000. On the new lower fee, so we're now going to use a slightly higher rate of return of 4.92%, you would be left with £402,000. So an extra couple of K in your pocket, not accounting for inflation, that can get you just over 300 pints of Guinness, which in fairness would be a pretty good night out. But as expected, when the fees were already so low, further marginal cuts, whilst they do increase the money in your pocket, they don't move the needle that much. If you could somehow reduce your fees by 0.5% or even 1 or 2%, that is where you will put 5 or even 6 figures back into your pocket over the long term. Now let's go back onto asset allocation, and this is arguably the most important decision you will make when it comes to selecting your investments in your own investment portfolio. And what that means simply is the split between stocks and bonds. Using a workplace pension as an example, most people, myself included in my past workplace pensions, get auto-enrolled into a life strategy target date retirement type fund. So that means in your 20s, you'll start off with a very high allocation to stocks, usually 90% plus, and the rest is in bonds. As you then move through your career and move towards retirement, towards the golden years, as they call them, the fund will then automatically de-risk you and move some of that stock allocation to bonds. So by the time you actually get, say, close to retirement or to retirement, you might be 50% stocks, 50% bonds. It really depends on the specific fund and also on your risk tolerance. The whole idea is, whilst bonds give lower returns over the long term, they're also lower risk. So it helps to smooth out the ride, and there's not as big ups and downs as if you were to stay in a 100% stock portfolio. This isn't often thought about enough, and in fairness, I've not really talked about it much just because I myself am in my late 20s, so I don't have any bonds at all in my portfolio. But that split between stocks and bonds, your asset allocation, really is the most important investment decision you'll make. The reality is, if you are investing solely into the stock market, you probably will see at least a few massive crashes of 20-30% plus in your lifetime. And a lot of people simply just can't stomach that. If you did have some bonds, whilst the returns might not be as good over the long term, the crashes also won't be anywhere near as bad. So whilst I do often say to people who are younger in their 20s or 30s to take a more aggressive approach, most likely because you have decades of compounding ahead of you, depending on your risk tolerance, your age, and ultimately what you're like as a person when it comes to money and investing, having an allocation to bonds, even if you are younger, might be the right way to go about it, so you don't have as much volatility or massive crashes or drawdowns in your portfolio. And as I mentioned, the easiest way to probably go about this in, say, your stocks and shares ISA is to have one global stock market fund and one global bond market fund. And now this fund being slightly lower in fees, that's a good thing. When it comes to stocks and bonds, I personally have no bonds and all of my money is still in the stock market. But as you get older, buy a house, have a family, build your career, maybe your risk tolerance, your time horizon, your goals change. So it's worth considering whether you want any bonds now, or at what point in the future you might want to invest into bonds to smooth out the ride a little bit at the expense of lower returns. And that is asset allocation. A rule of thumb you might have heard is take 100 minus your age, and that is how much you should have in the stock market. For example, if I am 27, I am 27, so I would have 73% in stocks and 27% in bonds. If you want to be a little bit more aggressive with this, you can take 120 and then minus your age. So using me as an example again, that would then mean I'd be 93% in stocks and 7% in bonds, which, to be honest with you, because I've got decades ahead of me when it comes to investing, that makes more sense. I'm not a financial advisor, of course, but I personally do think, particularly with workplace pensions, you often get auto-enrolled into a fund that often has bonds already in it. In my very first workplace pension at 20 years old, I was in a fund that had an allocation to bonds and cash. I couldn't access that money at that point in time for 35 years. So what I did with my own personal investment in that workplace pension, I switched the money into a 100% global stock fund. Now, you might not agree with that. You might have a different view. You might want to take a different approach. You might want to have more bonds at an earlier age or go into bonds at an earlier age, and that's completely fine. But as long as you're thinking about it and making the conscious choice with your asset allocation, that's the main thing I'm trying to get across. I actually personally think, and this might be an unpopular opinion here on YouTube, but I will stay in a 100% global stock market equity fund for my entire investing time horizon. TLDR, the reason being that it provides better returns over the long term, and I believe through my financial education, I would hopefully not panic sell and be able to ride out the ups and downs. And I've got an emergency fund. But yeah, I'll leave that one there. But if you want to see a full video on that one, let me know. Overall though, it is great that Vanguard have lowered the fees on these bond ETFs. However, in the UK, they also ideally need to cut their platform fees and especially their fund fees to remain competitive. And I cover all of that in this video right here. So give that one a watch next. Thanks for watching. Boom. All right, Saturday, 3:30, nearly time for a Guinness.